Hello, my name is Dan George. I'm a senior consultant with Elwood Associates for about another month. Elwood is in the process of combining with Cap Trust. We're very excited about the added synergies and additional resources we'll be able to bring to our client relationships. But I just wanted to start with that because between the date when this presentation is recorded and the playback, our name will likely be changing to Cap Trust. So now on to today's discussion. Avoiding the accidental spend down of your foundation in a low return environment. What do we mean by that? We're basically talking about spending more than we're making because the capital market assumptions that we have for all the different asset classes in which we're invested have come down so low that our expected return from our investment portfolio, just from an asset allocation perspective, is not enough to satisfy our investment objective. And so we'll put this in the context of our investment objective because for most of it is real growth after distributions. And we'll talk about whether or not we can get there just with asset allocation. And if we can't, what are some of the other sources of return that we can pursue? Things like active manager value added and tactical asset allocation, and certainly also reducing fees. So hopefully today's discussion will put into context the issue that arises when your investment portfolio is not set up to meet your investment objective, which may result in the accidental spend down of your foundation. So we know that asset allocation explains a lion's share of the return we can expect from our portfolio. But what we want to talk about next is how close does it get to our investment objective? Now, an investment objective can typically be broken down into subcomponents, but what we want to talk about first is the long-term return objective that foundations have. 83% of private foundations, per the Council on Foundations 2019 survey, have long-term return objectives. And those long-term return objectives average out to a target of about 7% when we look across the entire survey. And that's very consistent with our typical investment objective of real growth after distributions, which is a 5% spending rate, typically plus a 2% expected inflation assumption. So when we add those together, we back into the return objective to meet long-term investment objectives of real growth after distributions. Now, we want to pause here and just highlight the importance of having a phrase or a formula like real growth after distributions in our statement of investment policy, rather than a hard-coded number like a 7.0% return objective. The investment objective language of real growth after distributions contemplates more scenarios and gives us more flexibility down the road in case our inflation assumption changes or in case our spending rate changes. Rather than having to go back to our board and asking them to revise a new statement of investment policy, maybe with 7.2 or 7.5% return objective, having this investment objective written in a formula phrase gives us that flexibility that a hard number does not. So if we distill things down to a formula with real growth after distributions as our investment objective on one side, we see the variables on the other side of the equation that we use to balance the equation include expected return, which are driven by our asset allocation, our spending rate, and inflation. If we add those up, we either get a positive number and we have real growth, or we get a negative number and we do not have real growth. If we have real growth, our equation is in line and our investment program is set up to succeed. If we do not have real growth, that means we have more work to do. And that's a good catalyst to turn our attention to the asset allocation modeling framework. As we've talked about, asset allocation drives the expected return for a portfolio. And an asset allocation model is driven by capital market assumptions, which are basically inputs into an asset allocation software. Those capital market assumptions, which we'll talk about more in a moment, include expected return, a risk number, which represents standard deviation for each asset class, and a correlation between one asset class and all the other asset classes included in the model. The capital market assumptions are typically based on return assumptions for an index fund that represents each asset class. We want the broadest coverage of each asset class so we know what to expect when we're basically living out the asset allocation model in the real world. So a broad-based index is used as a proxy for each asset class, and therefore we can look at the history of a broad-based index fund as a proxy for the asset class's return, risk level, and cross correlation to other asset classes. So if we're using index funds as proxies for our capital market assumptions, it just reinforces how our capital market assumptions are net of any investment management fees. So we don't have to worry about backing out of our asset allocation model expected return investment management fees because we're using net of fee inputs. That's very important because remember our variables did not include investment management fees because we're assuming our modeling is net of investment management fees. But if we're using index funds, we're also assuming there's no value added from active management, at least in the asset allocation modeling output. If we want to assume alpha or value added from active management, we'll need to add that in on our own. So let's look at a couple of capital market assumptions that stand out in the 2021 version of Elwood's 10-year capital markets assumptions. On the top circle we see on this page, the expected return for large cap US equities is 5.9%. That's down dramatically from what we've seen large cap US equities perform over decades. And it's down because we've been on a bit of a run here over the past 10 plus years, expansionary economy, very strong stock market, which has caused it to get expensive. And when we have high price to earnings ratios or other valuation metrics for one of these asset classes, we do build in over the next decade, which these capital market assumptions are expected to cover, we do build in the expectation that those valuations will come back down towards their long-term average. So if we're at a highly elevated valuation for large cap US equities, we're going to write down over the next decade our expected return, and that's why the 5.9% looks low for large cap US equities. Actually, all of the equity markets are considered fairly expensive right now based on their history, and they've all been written down pretty much in concert with the write down on large cap US equities. When we look at emerging markets, we see a more competitive return, 7.1% return, and a return premium over large cap US equities. But what's interesting is if we're trying to get to an expected return of 7%, historically, we would heavy up on the US equity front and add in some emerging markets. But if we overweight large cap US equities, we're only going to get so far in our goal of achieving an investment objective of 7% because we're expecting 5.9% from that asset class. Emerging markets are more additive in helping us reach that goal. But when we look at the next circle on the page, private equity, we see an expected return, actually the highest expected return on the page of 9%. And below that, private real estate. Now, this is more actively managed real estate. Further down the page, you'll see core real estate and other asset classes. But this value add and opportunistic real estate is more actively managed and has a higher expected return than core real estate. But at any rate, when we look at the expected returns for private equity and private real estate, we see a return premium because these are illiquid asset classes, and historically they produced a return premium relative to public equities across US and non-US markets. So we want to keep that in mind as we look at our asset allocation modeling. If we're seeking a higher expected return, just relying on the public asset classes like large cap US equities and emerging markets may not get us close enough, and we may prompt us to consider these illiquid asset classes. Then lastly, let's look at the bottom circle on the page. Intermediate fixed income. This is a core bond portfolio. It's an aggregate of treasuries, mortgages, and corporate bonds. An expected return of only 2%. Right now, the 10-year US Treasury is hovering at about 1.35%. And so while corporate bonds and mortgages would have a return premium above that, that just lets us know how far we have to go to get to a 2% expected return in the bond markets. We have to have some increase in interest rates to even get to 2%. And that doesn't even get into the topic of how we're in a very low interest rate environment when we look back over historical rates. So if we expect rates to revert back at least closer to their long-term average over the next decade, we expect rates to go higher, and that means bond prices go lower. So while we do expect rates to exceed 2% over the next decade, we understand, and that comes with some price depreciation on fixed income. And it keeps a lid on how high we can write up that 10-year expected return for the bond market. So when we look at these kind of usual asset classes that we would consider to build out a portfolio, we see that 3 out of 4 don't really help us as much as historically they have. And that may prompt us to consider illiquid asset classes as we're trying to build an asset allocation that will meet our investment objective. So on this page, we take a look at that investment equation on the left-hand side, but really trying to focus on how close to our investment objective does our asset allocation get us. And this is going to prompt us to do some asset allocation modeling and maybe prompt us to change our asset allocation, like I was just referring, maybe from a traditional only asset class usage over to the use of some illiquid asset classes. But there are other tools in the toolbox that we want to consider to try to balance this investment equation beyond just asset allocation that seem to be a little bit more optional to investors. So later on today, we'll talk about considering active management and which asset classes we might want to go active. Also, we'll talk about making tactical asset allocation decisions and bets or trades, if you will. And then lastly, we'll talk briefly about reducing fees. But the goal here is to use the tools in the toolbox that are at our disposal to bring this equation into balance so that we can avoid that accidental spend down of our foundation by not keeping up with the investment objective, which provides real growth after the distributions. So if we look at some asset allocation modeling, we see on the left-hand side 2 scenarios. The leftmost one is liquid-only asset classes. You'll see on the top half of the page, total capital appreciation asset classes are 69% in total, but that there is no allocation to private equity or private real estate. So this is just traditional stocks, US and non-US, large and small cap. The middle category has some diversifying asset classes, which aren't quite representative of appreciation and not quite representative of preservation. So we have this diversifying assets category in the middle. And then down towards the bottom, we see total capital preservation, which is a core plus bond portfolio, plus some treasuries, which are dry powder and market storms, totaling 16%. So let's turn to the right-hand side of this page and evaluate how this portfolio does in getting us close to our investment objective. We see an expected return, the circled number on the left column of numbers under scenario 1, the right half of the page, of 5.5%. That's pretty far south of a 7% investment objective, which means we would have a big gap to make up with some of those other tools in the toolbox. But let's keep going. Volatility risk of 11.7%. Standard deviation by itself, much like Sharpe ratio, the next step, which is a return per unit of risk or a measure of efficiency. By themselves, these are hard metrics to really get your head around. They're most useful when you compare them to other portfolios, which we'll do in another moment. And lastly, we would call out the probability of earning our 7% investment objective here is just over a 1 in 3 chance, which seems pretty low and hardly qualifies for us being able to say, yes, we've set this portfolio up to succeed. We expect success in pursuing our investment objective. There are a number of other downside risks included on the page, but let's keep moving and go back to the left-hand side of the page and evaluate another asset allocation, scenario 2, which includes illiquid investments or alternative investments. You'll see highlighted in yellow, 10% allocated to private equity, 10% allocated to private real estate, and 5% allocated to private debt. Down at the bottom on the left-hand side of the page, you'll see an illiquid allocation of 25% of the total portfolio. So that seems like a lot, especially if you're going from scenario 1 to scenario 2. But actually, a lot of endowments and foundations have this type of asset allocation and actually have more in illiquid investments. Illiquid investments are actually quite consistent with foundations' constraints that they need to operate within as they pursue their investment objectives, a perpetual time horizon, and a quantified, fairly limited annual liquidity need of 5%. So to the extent we can get comfortable that illiquid investments are consistent with our investment constraints, then we can use them to help us pursue our investment objective. So on the right-hand side, we go back to the top line and see how this new asset allocation improves our chances of meeting our investment objective. Well, right away, we see a 6.4% expected return, much better than the 5.5 with scenario 1, and a lot closer to our 7%. But it's interesting to point out, even with 25% allocated to illiquid asset classes, we're not at 7%. So it'll bring us back to, we'll probably need to revisit some of the other tools in the toolbox, which we'll talk about next. Interestingly, because of the diversification these alternative investments bring to the table, our volatility risk actually goes down at the total portfolio level. That has to do with the relatively low cross correlation of adding private equity and private real estate instead of having our entire equity portfolio in public equities. We're reducing the cross correlation between our sources of return, especially in the capital appreciation bucket, and that reduces our volatility risk. So our return goes up, our volatility risk goes down, and our Sharpe ratio, which is our return per unit of risk, goes up quite a bit compared to scenario 1. So we would say there's something here worth considering. Scenario 2 is a lot more efficient. It has a higher expected return, not to mention the fact that the probability of earning 7%, while not 50-50, which is probably the minimum that we want to accept, is quite a bit higher than scenario 1 at 43%. Also interestingly, when we look down the page at some of the measures of downside risk or worst case scenario analysis, we see, again, because of the cross correlation between the illiquid asset classes and some of the public equities that we also have in scenario 2, we have lower risk measures pretty much across the board when we compare scenario 2 to scenario 1. So not to beat a dead horse, let's talk a little bit more about private investments. They're not for everyone, but if they're consistent with your investment constraints, you should probably give them a look because of the benefits that we just described. There is a return premium over public equities, which we show in the top chart on this page, and we've witnessed over time in the stable of active managers that we use at Elwood. As I mentioned, there's good diversification benefits because the return in your capital appreciation category is coming from a different source, a whole lot of other private companies that aren't in your public equity portfolio. There's also an added source of active manager value add. When you look at how much an active manager in the public markets can beat its public benchmark index fund benchmark, if you will, the range is narrower than what a private equity manager, the margin of private equity manager can beat its benchmark. Said differently, when you look at the capital market assumptions for a public equity manager, it's harder for them to beat that capital market assumption than it is for a private equity manager to beat their capital market assumption. Even though the private equity capital market assumption is 9%, we talk to private equity managers, very few come in with an expected return for the next fund below 12 to 15%, and some are even higher. If we ask them if they could beat 9%, they would say probably yes with one hand tied behind their backs. The asset class has historically been able to beat its capital market assumption by a wider margin than the public equity managers have been able to beat their capital market assumptions. So that just helps us perform better over time. And as we mentioned, the investment constraints of a foundation seem very consistent with the use of private equity and private real estate, some of these illiquid asset classes. Some of the key tenets of an illiquid program that are critical when you're building out these programs include vintage year diversification. You want an investment in every single year because you won't know for a couple of years which year is the best and which is the worst. And while it'd be nice to say I'd like to avoid the worst, but you might actually end up by trying to time it, you might end up avoiding the best year because it's very difficult to know which is which until a couple of years down the road and things start to materialize. So the plan is to invest in every single vintage year and maintain that time period diversification over time. We also want strategy diversification. Within private equity, we want buyouts, we want venture capital, we want some secondaries when they're inexpensive, or when the market is going through the doldrums, we may want distressed equity. So there's a wide variety of strategy diversification across private equity. Likewise, in private real estate, there is value added, there's opportunistic, there are a wide variety of property types and regions that we would consider diversifying into. Within private equity, we do emphasize middle market funds because the alpha here, the value added from the managers, does remain strong and is more repetitive. It's more consistent over time. So as we look at our strategy diversification, we do have the largest allocation in private equity buyout. Due diligence is critical when you're picking any manager, but when you're picking a private manager that is very difficult to exit, it's that much more important. And we would focus on investment as well as organizational and operational due diligence. These are two key aspects of underwriting any investment manager, especially given the long-term life of these funds. And if you're entering into this asset class, you definitely want to consider a long-term focus because the funds typically have a stated life of 10 plus years. So a little commercial there about private equity. It is a very useful tool in the asset allocation toolbox, which is one of the key approaches to meeting our investment objective. But as we look at changing our asset allocation to get us as far as we can toward our investment objective as we can with just that step, we want to recognize the benefits of private equity. So the next tool in the toolbox that we want to consider using to help us meet our investment objective is active manager value add. Investors have historically looked at the performance of a broad index fund in a universe of active managers to see whether or not they want to index in that asset class. The higher the ranking of the index fund in that universe, the harder it's going to be to pick active managers and be successful in adding that extra value. And given the added fees for active management, investors have typically gone towards index funds when the index ranks very highly in a universe of active managers. And this has led investors to use large cap US equity index funds and large cap developed non-US equity index funds to replicate the S&P 500 and the EFA indexes. When we look at how these indexes have ranked historically, we see that the S&P 500 has performed very strongly with an 11th percentile ranking over the past 10 years, again, in a universe of active managers, 10 years ending June 30th, 2021. The 5-year number is equally strong in terms of its ranking and pretty much indicates a safe bet to index in the large cap space. Now, in the developed non-US space, the universe ranking for the EFA index fund is not quite as high. A 44th percentile ranking leaves a pretty good margin for the pursuit of active management. And likewise, when we look at a 53rd percentile ranking over 5 years, indicates there's some opportunity here to pursue active managers. But we'll talk more about the developed non-US space as we look at some other asset classes. So staying with the probability of success and evaluating what the likelihood of picking a successful manager, let's look at small cap and emerging market spaces. The small cap US value and growth markets have been pretty difficult to beat for an index fund. When we look at the index fund ranking of a 72nd percentile performance, we see that 72% of the active managers have beaten this benchmark. That's a very wide opportunity set for an institutional investor trying to pick an active manager to beat the index fund. And the 5-year numbers really aren't that much different. And so we would say there's a pretty good likelihood that we're going to lean towards active management just based on the probability of success in the US small cap space. Non-US small cap is a little mixed. A 32nd percentile ranking doesn't leave much room for picking a value add active manager. And some investors might say that's close enough, being right inside the top third of the universe is satisfactory. But when we look at the 5-year number, we see a 50th percentile ranking. So we'll put that alongside the developed non-US space for more consideration. Emerging market rankings, probably weak enough for the index fund that we would pursue active management in this space. But it's important to not just look at the probability of success. We also want to look at the reward that we would get if we do pick a successful manager. What's the upside if we get a good manager? So let's take a look at how we can measure that reward for being right in picking a good active manager. Reward can be measured basically by looking at the 5th percentile performer, a pretty common breakpoint in Manager Universe performance breakouts. The return of a 5th percentile performing manager versus the return of a 50th percentile performing manager as the spread that might represent the upside of picking a good manager. The wider that the difference between those two, the more upside or the better the reward in pursuing active management. And so that may skew our decision if we see an asset class that has a harder probability, a lower probability of picking a good active manager, but a bigger reward. That may prompt us to actually go active despite the probability. So let's look at the chart at the bottom of this page, which includes 5-year universe rankings, returns for the 5 years ending June 30th for the 5th percentile ranking and the 50th percentile ranking. And importantly, the bottom line, they're the difference. On the far left, we see the large cap markets have the narrowest reward, if you will, the smallest reward, which means picking an active manager in this space gives you the smallest upside of the different asset classes on the page. Because as we look at the small cap markets and the emerging market return difference, we see they're much wider and that the reward is much greater if we do spend our time trying to identify active managers in these asset classes. The 10-year returns and return differences are pretty consistent with the 5-year numbers, with the large cap US and large cap developed non-US being the smallest rewards. What's interesting in this 10-year chart is the reward for small cap value is much smaller than the other small cap and emerging market return differences. So we'll consider that as we try to put both the probability and the reward in selecting active managers together in the following charts. So this chart just plots probability of success on the vertical axis and reward of being right on the horizontal axis. We just defined reward as the 5th percentile return minus the 50th percentile return in each of these universes of active managers. The probability is basically the universe rank of the index. And so when we look at a 70th percentile ranking of our 70th percentile ranking of an index fund, that means it's being outperformed by 70% of the active managers. And so that leaves a wide margin for our active managers in these different spaces. And so the higher a plot point on this page, the more compelling the probability is for us to pursue that asset class from active management. We added some concentric circles here just to show where the opportunity is least interesting. Again, we want a high probability and high reward. So where we want to be on this page is in the northeast quadrant, the top right corner. And we see our US large cap is nowhere near that with a relatively low probability and low reward for picking active managers. Our developed non-US is not too much farther away, though it is differentiated from US large cap. But we see the opportunity in small cap and emerging asset classes differentiated from the developed non-US. So these are 5-year, this is 5-year data. Let's go ahead and look at 10-year data and differentiate these different asset classes from each other using the 10-year data. Again, US large cap, not very compelling, very low likelihood of success and not much of a reward. And here we see, while the US small cap doesn't have that much, US small cap value doesn't have that much of a reward advantage over the developed non-US, it does have a much higher probability of success. And the combination of those two factors on a page like this may, especially when you consider the differentiation that we saw on the 5-year page for US small cap, which looked much more compelling, that may prompt us to go ahead and use active management in US small cap value. The US small cap growth and emerging market looked very compelling with both a high reward and relatively high probability. And while that non-US small cap 10-year probability is relatively low at 32nd percentile, only a 32% chance of picking a value-added manager, the fact that the reward is so great may prompt us to pursue active management in this space. And quite frankly, it actually has. We've had great success in finding that 33% of active managers that have outperformed the benchmark and have added significant value given the large upside in this space. So hopefully a framework like this will help investors put together both the probability of being right with the upside of the reward of being right, because we only have so much time to pursue active management in competition with all the other investment topics that we need to keep up with. So hopefully a framework like this will help investors differentiate how to pursue active managers. The next tool in the investor toolbox that we want to talk about as we pursue our investment objective is tactical asset allocation. Tactical asset allocation is defined as identifying an investment theme that's expected to impact the capital markets and changing your investment structure to take advantage of this information to either increase return or reduce risk. It's difficult when you're looking through the world using an efficient markets lens, like the efficient market hypothesis, which assumes all information, either public or non-public, is priced into securities prices at all points in time. It's difficult to rationalize the use of tactical asset allocation. But a great deal of energy is going into the identification of these investment themes that are expected to play out and surprise the market. A lot of this comes from the financial media, but also hedge funds, which are really set up, many are set up to use top-down capital market information as a main input into their investment theses. The sources of these ideas, these investment themes, might include your investment committee members or proactive recommendations from a financial advisor. Important to remember that we don't need to look for home runs. Singles and doubles will help us close the gap between our expected return from our asset allocation and the investment objective we're trying to reach. So as we're talking about tactical asset allocation, let's introduce a few rules of thumb. We would focus on fewer and higher probability themes. We want to read the writing that's on the wall when it's in large font and bold. We don't want to pursue smaller themes that have lower probabilities or are less likely to come true. One way to pursue this higher probability is to look for themes that have multiple catalysts of supporting them. Several factors that are expected to come through that would reinforce or act as tailwinds to increase the likelihood that the theme will materialize. We also want to avoid simple reversion to the mean trades. These tend to lack a catalyst. For instance, small cap value has lagged large cap growth for a long, long time, and we would expect the reversion to the mean anytime now. We're not sure why, it just seems like it's been long enough. The timing of the reversion is very difficult to forecast, and the absence of a catalyst means it's probably not a great idea. We would also identify your exit point as much as you can before you enter the trade. If you think one asset class has the opportunity to outperform another by 10 percentage points or 5 percentage points, well, when you reach that level, think seriously about exiting that trade, and you may just follow the practice of exiting whenever you hit that exit point. This helps us avoid giving back the value added we earned by being right initially by watching the trade go kind of round trip against us as the value dissipates. We would also say that you can move a modest amount of capital to make some extra return through these tactical asset allocation shifts, but you want to move enough so that you have an impact in your portfolio. A 5 basis point impact to your total portfolio is probably not enough to justify the effort of the tactical asset allocation shift, but perhaps a 20 to 25 basis point total portfolio return would be enough. So as you look at your exit and the amount of capital you're willing to move, you want to dial it, you want to pursue those strategies and dial it up to an impact that is within a range that is at least meaningful. One guide is to look at your rebalancing ranges as you have asset allocation targets with a plus or minus 5 percentage point allowable range around each asset class, perhaps. If you move 4 percentage points between asset classes, you're still within your policy ranges, and you don't need to revise your statement of investment policy, and importantly, not outside your statement of investment policy. That's not what this is about. But you're still within those allowable ranges and within the guidelines of your statement of investment policy. And 4% may be enough to make a meaningful impact to the extent the investment theme has an opportunity sufficient to earn that 20 to 25 basis points. We would look through an intermediate time horizon lens of 1 to 3 years. We're not talking about a trading strategy that goes from day to day or week to week or even month to month. And we're also not talking about 10-year asset allocation shifts. That's a strategic asset allocation shift. We're talking about investment time horizons of about 1 to 3 years. And importantly, we would embrace dislocations in the market. It's hardest to move the capital when the market is being disrupted by a credit crisis or a pandemic, but these are often when there are opportunities to invest in some of these themes that have the opportunity to add value for your total portfolio. Some current strategies that we can cite as examples of tactical asset allocation shifts. One might be fixed income duration. This would be an investment structure change within your fixed income portfolio as opposed to between asset classes, where you shorten the duration of your fixed income portfolio in advance of a potentially rising interest rate environment. To the extent rates go higher, your duration measures the negative impact on your portfolio. If you have a duration of 4 years, rates go up 1%, you have a negative 4 percentage point impact on your portfolio. If you cut that duration in half by investing in shorter term bonds, you protect your portfolio and reduce the risk from the rising interest rate environment. This is a very difficult trade to get right because interest rates are very difficult to forecast, but a lot of investors are contemplating this. Real assets, this would be an asset allocation change if you add an allocation to real assets. And by this, we mean hard assets like infrastructure or real estate or commodities. These would serve as a good inflation hedge as inflation is ramping up. Or you could do pursue this inflation hedge through an investment structure change by adding Treasury inflation protected securities to your bond portfolio, which are indexed to CPI. So as inflation ramps up, these bonds are actually protected and enhanced in value from a higher CPI. Leaning into cyclical and small cap stocks might be an investment structure change within your equity portfolio, perhaps increasing exposure to maybe small cap value and including small cap as the economic rebound picks up speed, which is an environment that has historically favored these market segments. The good old-fashioned stock bond mix change, to the extent you expect bonds to have a headwind and stocks to have a tailwind because of the strong economy and low and potentially rising interest rate environments, you might go back to that rebalancing range example and move 3 or 4 percentage points from fixed income to stocks. If you expect stronger outperformance from your equity portfolio over your bond portfolio, you multiply the percentage points times that you move times the percentage points in outperformance, and you might see that it's more than 20 to 25 basis points. And that may be a worthwhile trade to put on. And emerging markets. This might be an investment structure change if your source of funds is developed non-US, you're taking from large cap developed non-US and moving into emerging markets, or it might be an asset allocation shift if you're taking it from another asset class. But the higher growth rates and cheaper valuations and certainly the demographic tailwinds are supportive of this type of trade. A couple more concrete examples that we would share are in the bond market. On the left side of this chart, we have spread, which is the spread of these segments of the bond market interest rates versus the Treasury interest rates corresponding maturity bonds. So if we look at the spread between an investment grade credit bond versus US Treasury, it pretty much tells us what investors think about credit risk. If the spread is relatively low based on a historical observation, investors are comfortable with credit risk at that point in time and risk in general. But what we see in periods of panic or disruption, like we did with the pandemic in 2020, the spreads widen out. The bottom line on this chart is the green line is the investment grade credit spread versus US Treasury bonds. And we see that during the pandemic, when the pandemic was really impacting the market initially, the spreads on these investment grade credit bonds, which are high quality bonds, really widened out dramatically. We saw the opportunity to invest at very high spreads in securities that we thought were money good. These are investment grade credit bonds. And so in late March, we used other fixed income as a source of funds and invested solely in investment grade credit. And when spreads were at 2.55% versus treasuries, our target was about 1.45% spread versus treasuries. And we see that just a few months later, that spread occurred and we unwound the trade. The top blue line is the high yield market. And you saw spreads widen out that much more because these are riskier bonds. In our underwriting, we felt like these bonds were much more secure, and the historic default rate had not been incorporated into the analysis when the spreads were as far out as 7.73% when we put this trade on. Our exit was closer to 4.2%, 420 basis points, which we exited in the fall. So importantly, these trades didn't take even 1 to 3 years. The market rebounded much more quickly, but we had our exit points identified in advance. And when we looked at the amount of capital that we moved, it was just a few percentage points, 4 to 5 percentage points on each trade. It was meaningful, but not excessive when you look at the overall portfolio allocation. But it was large enough to make an impact, which we highlight in the top right box, where each of these trades, when you combine the total results, added 88 basis points in total portfolio return, which certainly helped us narrow the gap between our expected return from our asset allocation and our investment objective. So we would encourage you to consider a tactical asset allocation as one of the tools in the investor toolbox. The last topic we want to address is how to use fee savings to add to our incremental return to help us meet our investment objective. Now, we're all conducting these periodic checks for fee savings that can help us boost our net of fee performance, but one source requires added vigilance because it tends to fly below the radar. Mutual fund managers periodically offer access to lower cost share classes that your foundation may qualify for. The example we cite on this page is opening up access to R shares, which are previously reserved for retirement fund clients and suddenly open to all investors or maybe just endowment and foundation clients. As we look at the Templeton Global Bond Fund, we see that we had been willing to pay them 0.71% to give us access to their portfolio. And by doing so, we expect them to at least add 0.71 basis points worth of value versus their benchmark index. But if now we only have to pay 0.56%, we would still expect them to clear that prior margin of 0.71%, and we get to keep the extra 15 basis points to help us meet our net of fee investment objective. Typically, your advisor would keep an eye out for these opportunities because, as I mentioned, they're not often clearly advertised when they develop. So let's go back to the investment equation. On the left-hand side, we see our investment objective of 7% plus of real growth after distributions. And going back to our asset allocation modeling, scenario 2 gets us to about 6.4% expected return. We can adjust that asset allocation more, but eventually it's a law of diminishing returns that we get as far as we can get while still complying with our investment constraints. At that point, we can consider using more of the tools on this list and in the investor toolbox to help us meet our investment objective. So whether we end up spending more than we're earning or losing purchasing power to inflation, we need to avoid the accidental spend down of our foundations in the current low return environment. And that means closing the gap between our investment returns and our investment objective. So hopefully today's discussion renews the consideration of using some of the other tools in the investment toolbox that can help you to do that job. Hope this has been useful, and I look forward to answering questions in the chat discussion at the end of the day. Thank you very much.